Welcome to the Financial Planning for Canadian Business Owners podcast. You will hear about industry insights with award-winning financial planner and entrepreneur Jason Pereira. Through the interviews with different experts with their stories and advice, you will learn how you can navigate the challenges of being an entrepreneur, plan for success, and make the most of your business and life. And now, your host, Jason Pereira.
Hello and welcome to Financial Planning for Canadian Business Owners. I'm your host, Jason Pereira. Before we get started today, just a quick reminder to sign up for my newsletter at jasonpereira.ca, where you will receive notifications of all my various podcasts and television appearances. Now on to today's show. Today I brought on Trevor Parry, president of TRP Strategy Group. Trevor is one of the more respected tax and estate planning experts in the country. And I brought him on to discuss something called post-mortem planning. This is basically planning for what happens to your investments within your holding company when you pass away. Sounds pretty dull, but quite honestly, if you don't do it right, the tax rates are extortionate. And planning correctly does involve complexity. So I'm going to warn you, we get pretty deep on this. There's a lot of tax talk and it's a lot of heavy lifting. But if nothing else, take away the fact that if you're in this situation, you should be seeking out the right advice. And with that, here's my interview with Trevor. Welcome, Trevor.
Good morning.
And thanks for taking the time.
Thanks. Wonderful to be here.
Yes, well, it is morning. I offered you scotch and you declined because you're not that kind of guy.
It's only a problem if you admit you have.
Exactly. So, Trevor Parry, tell us about who you are and what it is you do.
I am the self-described tax mercenary. So I am a lawyer by training, collected a couple of tax degrees over the last few years, and I have a religious devotion to helping entrepreneurs prudently and safely save money from our dear friends in Ottawa who have different intentions regarding tax rates.
Yeah, I think they've demonstrated that different intention on multiple occasions. It keeps coming up on the podcast. So the reason I brought you on is to discuss something called post-mortem planning. So I've already talked about basically business owners, corporations, capital gains exemption, and basically why you need to have shareholder agreements and what happens when you die if you're a business owner. But let's talk about, that's an active corporation. Let's talk about what happens when I'm a successful business owner and I've got a holding company that I've amassed a bunch of money into it. So let's use some simple numbers. We'll use, I basically managed to amass 2 million in there and I grew it to be 3 million. So I've got a large gain there. So I pass away. And there are actually multiple levels of tax at play here that people don't stop to think about. So tell me what happens if I pass away and nothing gets done.
And just as an aside, it's not just business owners. The vast majority of physicians in Canada are incorporated. And when they cease practicing, those medical professional corporations basically become passive holding companies.
Yep, that's right.
So it's pervasive where this threat can be realized. So we have no estate tax in Canada, unlike the United States. But we do have the peril of double taxation. And very simply, you're deemed to have disposed of or sold all of your assets the moment before death. Spouse can elect a rollover, but if there's no spouse to roll things over, there is a tax bill due in your terminal return. And basically, it's a capital gain. Currently in this province, 26.7. And there are, of course, rumors of inclusion rate increases, which if the government goes to a 75% inclusion rate, your capital gains rate is 40%, which is, in the investment business is terrifying enough because you're going to be triggering substantial sums, but at death, it's quite large. This is the point people miss because the much maligned 1%, we try to identify those folks who are in it. Well, any individual who's truly middle class at the point of death is absolutely part of the 1%, and the government knows it. So you face the first hurdle is the deemed disposition. That's a capital gain.
So that's some of the shares that I own in the corporation, and all likelihood, I started that corp with next to nothing. So I've probably got a cost base of 0, or let's call it 1, a nominal amount per share. So I've got a cost base of 1, whatever the company's worth, again, 3 million. Now, those shares are worth $3 million.
That's right.
Right? So I've got a $2.999999 million gain.
Yeah, at capital gains rate. So let's say between 27 and 40%. That's just the first leg of tax. Remember, corporations are legal persons. They survive you. So though the value of your shares has now been counted in your terminal return, assuming no rollover, you still have to deal with, or your estate has to deal with, that corporation. We assume that the estate has done the proper filing so that it's a graduated rate estate, which is critical. And you need to look at all key documents to make sure that's done. But what will happen is that if the intention and wish of the now deceased entrepreneur or physician was to pass their life's work onto their next generation, then in order to do it, we have to dispose of the company. We've got to wind it up, or we have to wind up their shares in it. And that's another leg of tax. That's a deemed dividend, and the deemed dividend will be taxed in one of two ways, either an eligible dividend or a non-eligible dividend, or a bit of both. Most of the time I see a sprinkling of both, and so I use in Ontario roughly an estimated rate of 45%. Now, there are people in our industry, unfortunately, who are, they like to terrify people by saying, if you don't do anything, you're going to pay, it's very likely you're going to pay double tax. Well, I would argue that's negligence. People don't act without planning. So what happens is very simple. You have a choice. And with prudent, tried and true planning that's been around for decades, you can really elect what tax liability you want to pay. Is it capital gains or is it dividends? So it's a bit like Monty Hall and Let's Make a Deal. Do you want door number 1, door number 2? And in fact, there is a door number 3.
Well, let's just go stop for a sec. So the big issue, I mean, as we said, the corporation is a separate entity. And what people have a hard time wrapping their heads around sometimes is that $3 million investment I had in the corporation, which had a $2 million capital gain, that gain does not get realized when I die. And what you're talking about is getting that passed on to the next generation. It's about taking that $3 million and passing it on to the kids. Well, I just paid on my shares tax.
About $800,000.
Exactly. Then the corporation hasn't even realized the capital gain on the investment it's got. So there's your double taxation. And then never mind the fact that you have to flow that through as a taxable dividend to the kids.
And that's going to be, if we're at 45% or something like that, there's $1.4 million of your 3 gone.
Yeah.
And the trick here is that if you're going to wind up the company and you do this within the first year of since the creation of the estate, so let's say within a year of death, you can do what's called a loss carryback. And that's complex, but it's common planning. And again, you need the right experts to put it together. But what in essence happens is that when the shares are bought back from your estate by the corporation for the purposes of winding up the company, that's called a share redemption. That triggers a capital loss. And that capital loss can be carried back. You have to refile your.
So I was talking about, where does the capital loss come from at this point? So
capital loss has been suffered by the estate. So your $3 million of shares have been redeemed, creating in essence a $3 million loss or something to that effect. Substantial loss, usually equivalent to the capital gain that you paid upon death. Well, then it's logical. It's section 164, subsection 6 of the Act. We, within a year, carry that loss, trigger the redemption, carry the loss back. And if everything goes perfectly, and it will, we've eliminated at least the first leg. We've eliminated the capital gain, but we're left with the dividend.
The capital gain on the triggered capital gain that happens when you die on the value of the shares. Essentially, you pay it when you die, but the estate gets the loss. It all wipes out, and then that's zero.
Exactly.
Okay.
So that is share carryback, loss carryback share redemption strategies, and those we see all the time. And that is, by the way, the default strategy that if our wonderful government decides to muck around with capital gains rates, we always have that. Because there is another strategy. As I said, there's 3 doors. If you would prefer to pay capital gains, what we want to do is eliminate the dividend. And that's done by something called a pipeline transaction or a bump transaction. And pipeline transactions have been around for years. The government has provided a wonderful, substantial guidance on how to do it. It basically involves creating a new corporation, issuing debt, and having the estate take shares in debt in return for absorbing or amalgamating the original corporation into the new co.
Yeah.
And as you know, what will happen is it bumps up the value of the shares.
So my kids set up a new corporation. Okay. They basically acquire the shares of my corporation from the estate in exchange for a loan payable.
Yeah.
And then they basically amalgamate both corps into one new corp.
Right.
And then they repay the loan.
Yeah. Yeah. So that will result, it takes, between 36 and 48 months to properly execute, but that will result in capital gains. So if you're sitting here saying today, well, we have 4 years and we'd rather pay 26 and change rather than 48, you're going to do pipeline. There are some issues with pipeline. I mean, in the wonderful Morneau proposals of a couple of years ago, it would have wiped out pipeline. There are forces inside of CRA and finance, although I believe them to be in a minority, that don't like pipeline. They could characterize it as surplus stripping and things like that. But for at least 2 decades, they have given us very clear guidance. And these transactions, so long as they're not abusive, if executed correctly, are fine. So you really have 2 options. There are ways to enhance those further, and it usually involves the use of life insurance, particularly when you look at loss carryback.
Let's talk about those steps. So if I do nothing and I don't know about this, I don't even know what they'll carry back, I'm going to pay 26% on the value of the shares growth, then I'm going to basically trigger the gain within the corporation to get the money out and then pay 48 on the way out.
Right.
And so essentially we're looking at, when you add this all up, we've seen numbers that exceed 70% of the amount.
Well, that's where if you did it outside
if you knew nothing about what was going on.
Let's say the individual passes and they don't go to a competent professional until 18 months after. Now you're paying double tax.
But that happens.
And it
happens all the time, right? So if in that worst case scenario, you're paying double tax, your tax rate, that $3 million, 70% of it just disappears. Yeah. So door number one, as we said, was the carryback. So in which case, the first level tax gets wiped out. The second level tax is dividends, in which case now we're at 48, which still is pretty substantial. We're looking at almost 1.5 million.
You'll get some eligible dividends. So I usually use 45.
Yeah, plus some capital dividend account, but
and you get your refundable dividend tax on hand back. So there are some benefits.
Yeah. And then we just established number 3, which was the capital gain scenario with the pipeline. So tell us about door number 4.
Well, door number 3 is door number 3 is a modified. We call it it's a hybrid. And we use a bit of both, and we put on our wizard's hats and show people the secrets of the temple. But it usually involves the use of life insurance. The reason is, as you know, life insurance will pay based on the age of the individual, the cost of the insurance, the adjusted cost base of the policy. It creates, as we know, capital dividend credits.
Yes. We talked about them briefly in other shows, but the good thing about capital dividend credits is those can come out to the shareholders tax-free at any time. And normally that's the portion of taxable capital gains that are not taxable, so 50%. But when it comes to insurance, that number is way higher and can eventually reach the entirety of the policy.
Canada, without a doubt, has the most positive rules and regulations in the G7 when it comes to permanent life insurance. If you read between the lines of the Income Tax Act, anybody with wherewithal, with wealth, should be putting this stuff in place.
Interesting, given the fact that our first prime minister was also prime minister and ran Canada Life at the same time. There's conflicts of interest. We wrote the book on that. So continue.
So what happens is that when particularly we look at the share redemption strategy, you have to be aware of some very technical rules called the stop loss rules. So it would not make sense out of any sense of fairness that you could take a whole bunch of money you received now tax-free and use that whole bunch of tax-free money to redeem all of your shares. Yeah. So they created these rules to equalize. And so in this scenario where we have no ability to roll over the shares, so it's the estate of the deceased, and we have a payment to the corporation of insurance proceeds, which has created a credit to capital dividend. We can redeem up to half of the shares or half of the loss created by redemption through capital dividend. If we go more than that, we're going to start to lose. They're going to stop loss rules will be triggered. We're going to start to disallow or eliminate our capital loss. So it allows you effectively, if the redemption was $3 million and you have $1.5 million of capital dividend, well, logically, your dividend tax rate just went from, I use 45 down to 22.5. Yeah. That's better than capital gains rates. And so for those of the people who are worried about an inclusion rate increase, there is hope, but you have to be prepared and you got to be able to look at the numbers and understand how things are being created. Now, the true door number 3 is where we start using elements of both. And in that instance, we are looking at a reorganization of the company, a very small one at the time you're putting the insurance in place, often to issue what we call special class insurance shares or skinny shares or whatever we want. But these track the cash value of the policy. They will be entitled to receive, subject to directors, the capital dividend credit. They will also prevent the cash value from being added back into the proceeds of deemed disposition at death. So if you had a $5 million cash value in a policy that you put in place with good conscience and good planning to cover off tax liabilities, guess what? $5 million gets added into your deemed disposition.
Gets paid into the corporation, it increases the value. But in this case, that cash value is being attributable solely to those shares.
Who are going to be owned by your beneficiaries.
Exactly.
So, and then if we're doing a pipeline, capital dividends have no relevance in a pipeline, so you simply pay out the capital dividend credit through the special shares. So you've now effectively been able to reduce or somewhat slow the growth of the company because you're not adding this money back in. So that's great because we've now reduced our deemed disposition. Now we want to deal with the deemed dividend factors, and we still want that because if you have a passive investment holding company, as you know, you're most likely giving rise to the creation of a refundable dividend tax on hand credit. Yeah. You don't want to give that to the government. And if you do a pure pipeline, in effect, you do. So,
and for those of you who want a refresher on that, there was my episode with Kim Moody, where we talked about those notional accounts. Pay close attention because those are very important.
And he's a snappier dresser than I am. So
it's a pretty close race. He wears more bright colors.
Yes, he does.
Yeah.
The key is to get your RDTOH balances back in. So by starting with, perhaps we'll do some share redemption to reduce our already reduced deemed disposition, that will further reduce our effective first leg of tax. And then we will execute pipeline to take out the remaining dividends. So again, each case is different. The older you are, the numbers aren't as powerful. In certain instances, I've seen them where folks are in their 80s and it just doesn't work. So you're left with really the share redemption loss carryback or pipeline, and you don't mix the two. But the key is really to be able to whiteboard it, because tax at the end of the day is connect the dots, right? And checklist. And so
there's no one silver bullet here. We're combining a bunch of strategies, comparing different strategies to fit the situation, and determining what works best for the client.
And the ability to pivot and the ability to provide prudent and flexible planning. Because if our dear friends eliminate the ability to pipeline, then we are left with share redemption, and certain facets of the hybrid will not become manifest. So we always want to be able to not lock a client into planning rigidity.
Yep. No, it makes sense. So, I mean, we are talking about pretty big disparities. We're talking about rates that, with no knowledge and no proper advice, you're looking at losing in the 70s of that $3 million.
In the 80s, if they go to a 40%.
Yeah, in the 80s, if it goes to the 40%, I mean, that's, that's
Marxist is what it is.
Well, yeah, I mean, even the former head of the NDP said anything north of 50% is confiscation. That came from the NDP.
I'm sure they've thrown him out of the party.
Well, yeah, he's no longer running it. Anyway, so there's that, all the way down to basically the 20s. We're talking about the low 20s.
So you get teens.
Yeah,
you can get teens.
Exactly, right? Like, we've seen these cases where they get below 20%. And when you think about, I mean, first of all, it's unfair to the average consumer. The tax code is so complex that literally...
And Jason, you can actually, in certain instances, again, if you get the client, if they're good savers and they're younger, you can get to zero.
Yeah.
And that's a modification of our share redemption. It's called a spousal roll and redeem. So I do this a lot with younger doctors, or particularly dentists, because dentists tend to get saving faster than doctors, but just to paint with a wide brush. But
their debt typically is less when they get out of school.
Sure.
Yeah.
So what happens is that rather than the estate acquiring the shares upon death, the spouse receives them pursuant to a spousal rollover. And in this instance, again, life insurance is critical. You will create that capital dividend credit upon the death of the insured. But because you're redeeming the shares from an individual, a corporeal being, rather than an estate, a trust.
We haven't triggered that first level of tax.
You don't have a deemed disposition, and there is no stop loss rules.
Yep.
So it is theoretically possible. I've illustrated it many a time where zero is a potential tax rate on corporate redemption in these instances. When you get into the very, very high net worth folks, your insurance costs can be quite astronomical, or very high, in which case we probably have a prudent conversation.
Astronomical compared to what is the issue, right? We're talking about losing 70% of something. I mean, that's the advantage that we often spell out. End of the day, you're going to pay something for insurance, but that number is going to be a heck of a lot lower.
And again, there's prudent use of leverage in financing insurance too. So you can really mitigate the impact to cash flow.
So let's talk about that. So we've talked about different strategies for how we basically deal with this, and then with massive impact differences. I mean, we're talking more than 4x differences in taxation, right? Which, again, as I was starting out with earlier, the fact that the tax code is this convoluted doesn't really service the Canadian consumer, but it does mean that business owners need to take the time to get the right professionals in place to make sure that their families are going to definitely benefit from what it is that they've built. So now let's go on to the insurance. We'll go back to the insurance piece. So one of the pushbacks is always quite simply like, basically I could do a better return in my business, or why would I pay this? Well, the trade-offs are, as I said, one, well, you're going to have a tax bill one way or another. Would you rather pay a couple dollars, pennies to the insurance company or dollars to the government? Your choice, depending on the math of it. Let's talk about how we can reduce the cost of insurance through leverage. How's that work?
Well, we've already started down the road. I have 4 questions that I pose to the client, usually resulting in a 15 to 20 page treatise. So the first thing I ask is, do you need the coverage? And we go through intensive financial planning and rip the corporation apart and try to get a good sense of realistic tax liabilities. And the answer will come back, yes. In most cases, you need the coverage because you're funding your liability at a discounted rate. That's all insurance does. And it's a big accordion folder. The second is, can you afford it? Which is an understanding of cash flow, because you cannot impair their cash flow. And unfortunately, there are charlatans in our industry who will use financial alchemy to do just that. So being cognizant of that, and of course, the psychology of insurance and of cash flow. Nobody wants to buy life insurance other than insurance agents.
No one ever wakes up and says, "Today's my day. I'm gonna make it happen. I'm gonna buy life insurance."
Honey, it's Patrick. He bought life insurance. I remember that ad. I mean,
it's a great commercial.
So
because no one had never actually happened.
But if you focus on the tax liability, on the tax planning, on creating an asset from day one. So creating significant cash flow as fast as or cash value as possible. These things mitigate against the psychology of it. So the second question is an understanding of cash flow. Can they afford it? Are they ready to afford it? The third question is, can you do better with this money that we're going to put into a policy? Invariably, because of course real estate never goes down in this fair city.
Let's never go. Let's not go there. But nevertheless, the real estate bugs believe that and will believe nothing else.
And some of the investment people too. But it's what will happen is that they'll always come back and say yes. And usually the smart ones are the entrepreneurs. They say, listen, I've got a 20% IRR in my company. I can do better.
Yeah, absolutely.
So this is where the fourth question comes on, and I put on my lawyer's hat and I say, okay, what's your gut sense of risk? And then we nuclear test the transaction. We show stress tested numbers, lower performance in the policy, what increase in borrowing costs, what happens if an unforeseen event happens and we have to take this down, what are the tax consequences? Because it's a complex transaction.
So the steps pretty much are policy gets established, and I think I talked about this in the show before, you can put additional funds into a policy depending on the type, and that creates a cash value. What we're doing here is we're cutting the check to the insurance company and then turning around and borrowing that cash that's within that policy.
You're securing against, you're collateralizing the policy and securing against that. So it gives rise to interest rate deductions and a deduction of something called net cost of pure insurance. So the impact to cash flow is it's attractive in the sense that you can keep most of your money. And this is how most of the large case planning driven insurance cases are being done in the country, overwhelmingly.
But it works. I mean, first of all, it reduces the out-of-pocket outlay because now I'm getting back a lot of what I put in, most of what I put in. I'm getting these additional, I got to pay interest now, but I'm getting a deduction on that. I'm getting a deduction on CPI. So that reduces that. And frankly, I can wipe out the loan anytime I choose as long as I haven't blown up the investment.
And you need to have proper advice. There are riskier versions or more aggressive versions of that transaction, but the client has to first have a fundamental understanding at a DNA level, comfort level of dealing with debt. I usually tell the client, you're not going to have this paid off at death. This is an intermediate strategy that at some point you're going to sell an asset, the business, who knows, take the loan out, because then the policy just becomes an absolute war chest of tax-free money.
When you decide to retire and you want to stop playing this game, you can wipe out the loan.
Right. But
if you die between now and then the loan will be taken care of by the insurance policy.
Exactly. So it can work in the right scenario with the right parties. It works very well. Again, there is some aggressive use out there. Our friends at CRA are, I believe, starting to police this stuff.
Well, we've seen that. There's been a lot of change to insurance law in the last 4 to 6 years.
Yeah, I mean, most of it's just been updating, not so much like the 2016 exempt trust changes were just updating for interest rates and mortality.
And that's fine.
Not a real problem. And competent folks like yourself and myself in the industry were able to deal with that.
And realize it was necessary.
Yeah.
People were living longer. It just didn't make sense to give them the same kind of discount.
But there's always, there's the chicken little, the sky is falling mentality that they're going to get rid of capital dividend credits. And of course they're not. They will.
If they did that.
No, I know. It's not happening. I think you're more likely to see further policing and further attention to what they determine to be aggressive use. But if you go into it with eyes open and you're properly advised and you don't undertake financial alchemy and then remember the golden rule in tax, pigs get fat and hogs get slaughtered, I think you're fine. I mean, I've undertaken many of these transactions. I'm very comfortable with it. We engage a team of folks like yourself with lots of letters beside their names to make sure that it works.
Yep. And at the end of the day, when it comes down to the business owner and their choice, I mean, their choice is quite simple. They can either do nothing and hope the people left behind know enough to basically get something taken care of within the time frame allotted. Otherwise, they're going to leave behind a unbelievable minority of what was left behind for them, which doesn't make any much sense, or take it upon themselves to do a little bit of planning ahead of time.
Right.
Yeah, you know what? Everything we talked about is complex. Like, the average business owner is not going to follow along everything we said today. But frankly, putting together the right team with the accountant, the lawyer, potential lawyer.
One of my mantras is that, because I get people saying this is complex, and hey, it is. Look at the size of the Income Tax Act. My job, your job, is very straightforward. We can make this understandable. We cannot make this simple.
No.
Simple as a sales pitch.
Well, and as I say to clients all the time who basically come to me and they're like, I lead a simple life. Well, you're an American citizen. You have a corporation, an operating corporation. You have property in other countries. No, you don't.
It's not
and,
simple.
Well, I want a simple plan. It's like, well, then sell everything and renounce your citizenship. Because frankly, we can't make a complex situation easy and simple on the estate planning route. It's just not the case.
And I would tell them never to renounce, because if they renounce for tax purposes, they will be barred entry to the U.S.
Yes.
Et cetera, et cetera.
I mean, renouncing is not as hard as people think it is, but avoid it. It's not necessarily what you want to do, because it really isn't that big a pain in the butt. But again, if you're a U.S. citizen, there's certain degrees of planning you got to do, and there's complexity to that. You can't escape it. So you either take the chances on not letting me back in the country, or you basically plan around it.
And the other thing, just as you're talking about U.S. citizenship, insurance planning is wonderful stuff, and you should know, as you do, that the U.S. rules governing permanent life insurance are very different than ours. And if you are a U.S. citizen or a U.S. person and you want to buy a robust Canadian policy for purposes of funding your tax liabilities, as we talked about today, arguably you can't. You need to have actuarial eyes on what you're looking at to make sure you're compliant with the IRS, because they will tax you on the growth of the policy, where the Canadians won't. And death benefits are not necessarily received tax-free, and estate tax perils and all kinds of stuff subject of a whole different talk.
Yeah. I mean, besides having the cross-border expert in there who understands the tax situation, you also need to make sure that the company that you're dealing with and the policy you're dealing with, it can play within those rules, and not every Canadian policy does, that's for sure.
No, most don't. I mean, most whole life policies don't fit.
Yeah.
So it's good. Coming from the actuarial world, I know a number of folks who are very good at cross-border compliance. If your listeners need help, they can contact you, and we can gladly pass along those names.
Great. Well, Trevor, this has been a heavy lifting topic, but one that's very important, because when we start talking about tax rates that are north of 70,
they're not morally defensible.
Yeah, exactly. I mean, like, this is big money, right? Like, I mean, we're not doing this. We're not talking about this for people who have holding companies that are sitting on $20,000, right? Like, these are people who use these
remember,
things.
our dear friends in government want you to do nothing.
Exactly. Well, I mean, the choice is you educate yourself, get the right people in place, you basically do the right planning. It's going to cost you a little bit, and it's going to cost you a fraction of what they would otherwise receive if you did nothing.
Right.
And they win every time someone doesn't plan. So thanks for coming in. This was, again, a heavy lifting topic, but an important one. Where can people find you?
Trevor at trevorparry.com. That's Parry with an A.
Excellent. Thanks again. So that was my interview with Trevor Parry. As I warned you, this got pretty heavy and the tax rates got extortionate. So hopefully this resonated with many of you and has made you realize that you need to do some planning around the assets within your holding company to make sure that those assets go primarily to your family and not to the government. As always, this has been the Financial Planning for Business Owners podcast. I'm your host, Jason Pereira. And if you enjoy this podcast, please leave a review. Until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals, business owners, and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on Apple Podcast, Stitcher, Google Play, Spotify, and SoundCloud. For more episodes, go to jasonpereira.ca. You can even ask Siri, Alexa, or Google Home to subscribe for you.